$29,000. That's how much a 1% fee can cost you on a $100,000 investment over 20 years. The SEC ran the numbers. A 1% fee can eat 18% of your final balance. That's not a tiny cost. That's a down payment. A car, years of travel. And it happens quietly, year after year. By the end of this video, you'll know exactly how fees work, how to spot them, and how to keep more of your money working for you. You're doing everything right. You're saving, you're investing, you're thinking about the future. But there's a silent leak in your plan. It's not the market. It's not taxes. It's the fees you probably never read about. They look tiny, 0.25%, 1%. What's that, right? But here's the thing. Those small percentages compound against you. They reduce what you earn, and you lose the returns on that money too. Most advice focuses on picking the right stocks or timing the market. That's hard. Fees are different. They're predictable, they're controllable, and they could be costing you more than you think. This video will show you exactly how fees work, why they matter so much, and how to slash them without fancy tricks. You'll learn to see fees as the silent tax on your future. You'll learn the difference between transaction fees and ongoing fees. You'll learn why index funds are your friend, and you'll learn why trading too much can hurt you. By the end, you'll have a clear plan to keep more of what you earn. Let's start with the basics. Fees are costs you pay to buy, sell, or hold investments like mutual funds and ETFs. They come in two main types: transaction fees and ongoing fees. Transaction fees are charged when you buy or sell. Think of them like a toll booth. You pay every time you pass. Ongoing fees are charged regularly, like an annual expense ratio. That's a percentage of your investment taken out each year. You don't see the bill, it just quietly reduces your balance. Think of it like a subscription you forgot to cancel. It keeps charging you month after month. And because that money is no longer invested, it doesn't grow with the market. That's the quiet part. It's not just the fee itself, it's the lost growth on that fee. Over time, that adds up more than you'd expect. Imagine you're watering a plant. Each fee is like a tiny hole in the pot. Water leaks out, and the plant grows slower. You might not notice a drop here or there, but after a year, the plant is much smaller than it should be. The same happens with your investments. Every fee you pay is a hole in your pot, and the more holes, the less your money grows. Now, some fees are unavoidable, but many are not. You can choose funds with lower fees. You can avoid funds with sales loads. You can trade less. The key is to know what you're paying. And that starts with understanding the different types of fees. Transaction fees are simple. You pay them when you buy or sell. They're like a cover charge at a club. You pay to get in, and then you're free to enjoy the night. Ongoing fees are different. They're like a monthly membership. You pay them as long as you hold the investment, and they can add up quickly. For example, an expense ratio of 1% means you pay 1% of your investment every year. If you have $10,000, that's $100 a year. That might not sound like much, but over 30 years it's a lot, and that's just the ongoing fee. There are also transaction fees. If you trade often, those can add up too, so it's important to think about both. The total cost of owning an investment is more than just the expense ratio. It's all the fees combined, and that's what you need to compare. Now let's talk about compounding. When you invest, you earn returns on your money, and those returns earn returns. That's compounding. It's how your money grows faster over time. But fees compound too. Here's how. Say you have $100,000 growing at 4% a year. After 20 years, with a 0.25% fee, you'd have about $208,000. With a 0.50% fee, you'd have about $198,000. With a 1% fee, you'd have about $179,000. That's $29,000 less than with the 0.25% fee. That's a 1% fee costing you 14% of your final balance. And the SEC found that a 1% increase in annual expenses can reduce your ending balance by 18% after 20 years. That's nearly 1/5 of your final pot, gone, just from a fee that looked tiny on paper. Think of it like a race. You're running a marathon. Each year, a fee takes a little bit of your energy. By the end, you're exhausted and far behind. The fee didn't seem like much at the start, but over 20 years, it's a huge disadvantage. Let's break it down even more. When you pay a fee, that money is no longer invested, so it doesn't earn returns. and you also lose the returns that money would have earned. That's the compounding effect. It's like a double whammy. You lose the fee, and you lose the growth on that fee. Over time, that adds up. For example, a 1% fee might seem small, but over 20 years, it can reduce your ending balance by 18%. That's a massive difference. So don't underestimate the power of compounding. It works for you when you keep costs low, and it works against you when you pay high fees. Here's the thing, if you're in your teens or 20s, the impact is even bigger, because you have decades of compounding ahead. Every year that a fee takes money out, it also takes the returns that money would have earned. Over 30 years, that's a massive difference. Let's look at a real example. Say you start investing with $3,000, and you add $250 each year, earning 8%. After 30 years, without fees, you'd have about $648,000. With a 0.50% fee, you'd have about $596,000. With a 1% fee, you'd have about $549,000. With a 2% fee, you'd have about $468,000. That's a difference of about $128,000 between the 0.50% and 2% fee. That's over $5,000 a year in retirement income, all from fees. Imagine you're planting a tree. The first few years, it grows slowly, but if you keep watering it and protecting it, it becomes huge. Fees are like cutting off a few roots each year. The tree still grows, but it never reaches its full size. You might not see the difference now, but in 30 years, it's the difference between a sturdy oak and a stunted sapling. And here's the key. You have time on your side. The earlier you start, the more compounding works for you. But fees can take that advantage away. So it's crucial to start with low-cost investments. You don't need to be an expert, you just need to pay attention to fees. And that can save you tens of thousands of dollars over your lifetime. You might think expensive funds are worth it. They hire smart managers, they pick stocks. But the research shows something surprising. Actively managed funds have higher fees, and they often don't beat the market. Index funds, which just track a market like the S&P 500, have much lower fees. For example, an index fund might charge around 0.03% a year. That's almost nothing. Active funds can charge 1% or more. And the performance? Many active funds don't even match the index, so you're paying more for potentially less. It's like buying a premium gym membership, but never going. You pay extra, but you don't get the results. The evidence is clear. Low-cost index funds are a smart choice for most people, especially beginners. You don't need to pick the next big stock. You just need to own the whole market at a low cost. And that's the beauty of index funds. They're simple, they're cheap, and they work. But there's a catch. Some people think all index funds are the same. That's a misconception. They can have different fees and different underlying assets. So you need to look under the hood, check the expense ratio, check what the fund actually owns. Don't just pick the first one you see. Compare a few. And remember, low fees are important, but they're not the only thing. You also want a fund that tracks its index well. But for most people, a low-cost index fund is the way to go. It's like choosing a reliable car over a flashy one. The reliable car gets you where you need to go without breaking down, and it doesn't cost as much to maintain. So don't be swayed by fancy marketing. Look at the fees, look at the track record, and choose the fund that keeps more of your money working for you. Another way fees sneak in is through trading. Every time you buy or sell, you might pay a transaction fee, but that's just the start. Frequent trading can hurt your returns in other ways. You might buy high and sell low. You might miss the best days in the market. The data shows that investors who trade often tend to earn less than the funds they invest in. In fact, over the 10 years through 2024, the average investor earned about 7%, while the funds themselves earned about 8.2%. That's a gap of 1.2 percentage points. That's huge over time. It's like trying to run a race but stopping to tie your shoes every 100 meters. You might be fast, but you lose time. And it's not just the fees, it's the timing. You sell when you're scared. You buy when you're excited. That's the opposite of what works. So what should you do instead? Buy and hold. Pick a low-cost fund and stick with it. Don't check your portfolio every day. Don't panic when the market drops. Just stay the course. Over time, the market tends to go up. And if you're not trading, you're not paying transaction fees. You're also not making emotional decisions. It's like being on a diet. You don't weigh yourself every hour. You trust the process. And over time, you see results. So resist the urge to trade. It's one of the best things you can do for your returns. Beware of sales loads. Some mutual funds charge a commission when you buy or sell. This can be up to 5.5% of your investment. That's a big bite right off the top. If you invest $10,000, you might lose $550 immediately. That money doesn't grow, it's gone. Think of it like buying a car and paying a dealer fee that's 5% of the price. You wouldn't do that if you could avoid it. But many people don't realize they're paying loads. That's why it's crucial to read the fine print. Look for no-load funds. Compare fees before you invest. A little homework can save you thousands. And remember, there are tools like FINRA's Fund Analyzer that can help you compare costs. It's free and covers over 30,000 funds. Don't let a sneaky fee take a chunk of your money before you even start. And there are other fees to watch out for too. Account maintenance fees, inactivity fees, exchange fees. They all add up. So when you're choosing an investment, don't just look at the expense ratio. Look at the total cost of ownership. That includes all the fees you might pay. And if you're not sure, ask, or use the tools available. The SEC and investor.gov have resources to help you. They're official, they're free, and they can save you a lot of money, so take advantage of them. Let me tell you about two investors, Sarah and Mike. Both are 25. Both start with $3,000. Both add $250 every year. Both earn 8%. But Sarah chooses a fund with a 0.50% fee. Mike chooses a fund with a 2% fee. He doesn't know better. He picked a fund that looked exciting. After 30 years, Sarah has about $596,000. Mike has about $468,000. That's a difference of about $128,000. Sarah can afford a nice retirement. Mike has to work longer. The only difference? A fee. Mike thought 1.5% more was nothing, but over 30 years, it cost him more than $100,000. That's real money. That's the quiet cost of fees. Sarah didn't do anything fancy. She just picked a low-cost fund. Mike didn't do anything wrong. He just didn't pay attention. And that's the scary part. Fees don't announce themselves. They work in the background, but the result is stark. One person retires comfortably. The other keeps working, all because of a small percentage. And think about what that $128,000 could mean. It could mean retiring at 65 instead of 70. It could mean traveling in retirement. It could mean leaving something for your kids. Mike gave that up without realizing it. He thought he was making a smart choice. But the fee was eating his returns year after year, and he never noticed. So the lesson is clear. Check your fees, compare your options, and don't assume that a higher fee means a better fund. It doesn't. It just means you're paying more. Now let's look at the bright side. Fees have been falling, especially for index funds and ETFs. In the first half of 2025, ETFs saw inflows of $540 billion. That's new money coming in. Why? Because people are realizing they can get low-cost exposure to the market. An index fund might charge 0.03% a year. That's almost nothing. And over time, that difference adds up. Take the $100,000 portfolio again. With a 0.25% fee, you'd have $208,000 after 20 years. With a 0.03% fee, you'd have even more. The point is, you can choose low-cost options. It's not complicated. It's not fancy. It's just smart. You don't need to be an expert. You just need to pay attention to fees. And when you do, the results can be dramatic. The money you save in fees stays invested. It grows. It compounds. Over decades, that can be the difference between a comfortable retirement and a struggle. So don't underestimate the power of low fees. And it's not just about index funds. Even actively managed funds have been cutting fees to compete. But the lowest fees are still in index funds and ETFs. So if you're just starting out, that's where you should look. You can buy a total stock market ETF for a few basis points. That gives you instant diversification, and you don't have to worry about picking individual stocks. It's like buying a pizza instead of making the dough, sauce, and toppings from scratch. It's easier, it's cheaper, and it tastes just as good. So here's what you need to remember. Fees are not your friend. They're a silent tax on your investments. But you have control. You can choose low-cost funds. You can avoid unnecessary trading. You can check the fees before you invest. And you can use tools like FINRA's Fund Analyzer to compare costs. It's free. It covers over 30,000 funds. Knowing your fees could save you tens of thousands of dollars over your lifetime. That's not a small thing. That's real freedom. So take 5 minutes to check what you're paying. Look at your 401k. Look at your IRA. Look at any investment you have. Find the expense ratio. Find any transaction fees. And then compare. See if you can find a lower cost option. It might take a little effort, but it's worth it. Your future self will thank you. If this video opened your eyes, hit subscribe. That way you won't miss the next one. And leave a comment. What fee are you going to check first? I want to know. Maybe it's your 401k. Maybe it's your ETF. Just pick one and look it up. Share this video with a friend who's just starting to invest. They might be paying too much in fees without knowing it. Help them keep more of their money. Thanks for watching. See you in the next one.